Frank Quattrone made $120 million in year 2000 alone, not from building companies, from taking them public. His investment bank, CSFB, underwrote 57% of all tech IPOs during the bubble. But Quattrone wasn't just an observer of the dot-com boom, he was its architect. Along with a small network of bankers, VCs, and analysts, he engineered the greatest wealth transfer in modern history. $5 trillion created, $5 trillion destroyed. And the same people profited from both. Welcome to the Wealth Timeline, where we uncover how money, power, and history intertwine to shape the world we live in. Today, we're revealing how a coordinated network of financial elites engineered the dot-com bubble, profited from its rise, and escaped before the collapse destroyed ordinary investors. The dot-com bubble didn't emerge from nowhere. It was built on three foundations, each seemingly legitimate, each concealing deeper mechanics. Foundation 1, the Telecommunications Act of 1996. On February 8, 1996, President Clinton signed the Telecommunications Act and the first major overhaul of communications law in 62 years. The goal was competition. The result was a telecom spending frenzy. Between 1996 and 2001, telecom companies spent $500 billion building fiber optic networks. WorldCom, Global Crossing, and Level 3 laid cables across oceans and continents. By 2001, only 2 to 3% of installed fiber capacity was being used. But the spending created an illusion. The internet was about to explode. Infrastructure was ready. Now we just needed companies to use it. Foundation 2, the 1995 Netscape IPO, August 9th, 1995. Netscape goes public at $28 per share. By day's end, it closes at $58. The company has never made a profit. Revenues are $16.6 million. Market cap reaches $2.9 billion. This wasn't just a successful IPO. It was a new formula. Profitability doesn't matter. Growth does. Eyeballs matter. Market share matters. The traditional metrics, earnings, cash flow, dividends, are obsolete in the internet age. The lead underwriter for Netscape's IPO was Morgan Stanley. The banker who pushed it through was Frank Quattrone, and he had just discovered that you could take unprofitable companies public and create billions in paper wealth instantly. Foundation 3, the locked network. But here's what most histories miss. The dot-com boom wasn't driven by retail investors discovering the internet. It was engineered by a tight network of interconnected players: investment banks, venture capital firms, institutional investors, and stock analysts. The mechanism worked like this. VC firms funded startups. Investment banks took them public through IPOs. Analysts at those same banks issued buy recommendations. Institutional investors, who received IPO allocations from the banks, flipped shares to retail investors at inflated prices. Then everyone repeated the process. The network was small. The same names appear repeatedly: Frank Quattrone at Credit Suisse, First Boston; Mary Meeker at Morgan Stanley; Henry Blodget at Merrill Lynch, Kleiner Perkins and Sequoia Capital on the VC side. This wasn't a market, it was a machine, and it was about to accelerate beyond anything the financial system had seen. Between 1995 and 2000, the NASDAQ increased 400%. But the money didn't flow naturally. It was pumped through specific channels by specific players using specific techniques. The IPO allocation game. Frank Quattrone's CSFB had a list. Friends of Frank. These were institutional investors who received first access to hot IPOs. In exchange, they paid higher commissions and directed other business to CSFB. The practice, later called spinning, was legal but ethically dubious. Here's how it worked. CSFB would take a company like VA Linux public. The IPO price was $30. On December 9th, 1999, VA Linux opened at $299 and closed at $239.25, a one-day gain of 697%, still the largest first-day IPO pop in history. Friends of Frank, who got shares at $30, made instant fortunes. Retail investors who bought at $299 lost 90% when the stock eventually crashed to $1.19. Between 1999 and 2000, Quattrone's team underwrote 57% of tech IPOs. He personally made $120 million in 2000. His bank made billions. The companies didn't need to be profitable. They just needed to go public. The analyst hype machine. Henry Blodget became Merrill Lynch's Internet Analyst in 1998. In December 1999, he predicted Amazon would hit $400 per share within a year. It was trading at $243. The prediction made headlines. Amazon hit $400 in 3 weeks. Blodget became a star. But internal emails later revealed the truth. Blodget privately called stocks he publicly recommended junk and crap. In one email about GoTo.com, he wrote, "I don't think we should be so aggressive on this stock. It's a pretty crappy company." Publicly, his rating was accumulate, tosh, buy. Mary Meeker at Morgan Stanley was dubbed Queen of the Net. Her reports on internet stocks were treated like scripture. Between 1998 and 2000, she had buy ratings on nearly every major internet stock. Very few sells, not because the companies were good, because Morgan Stanley was underwriting their IPOs or seeking their investment banking business. The conflicts were structural. Analysts worked for investment banks. Banks made money from IPOs and M&A deals. Negative ratings killed deals. So analysts gave positive ratings. The system rewarded optimism and punished honesty. The venture capital echo chamber. Kleiner Perkins and Sequoia Capital, Silicon Valley's most prestigious VC firms, funded hundreds of startups between 1995 and 2000. Many had no path to profitability. That didn't matter. The goal wasn't building sustainable businesses. It was getting to IPO. Kleiner Perkins funded Pets, Com, Webvan, and Cosmo. Com, companies that burned through hundreds of millions before collapsing. But the VCs still profited. They bought shares at early stage valuations of pennies per share. When the companies went public at $10, $20 per share, the VCs' returns were astronomical. Even if the public market investors later lost everything, the incentives were perfectly aligned for the insiders and perfectly misaligned for everyone else. By late 1999, the machine was running at full capacity. 457 IPOs in 1999 alone. 117 of them doubled on their first day of trading. The average first-day return was 71%. Retail investors, watching CNBC, reading analyst reports, seeing overnight millionaires, poured their savings into tech stocks. They didn't realize they were the last buyers. The exit liquidity for everyone who got in early. The collapse didn't happen suddenly. It happened in stages, each revealing a different layer of the mirage. Stage 1, the burn rate crisis, late 1999. By late 1999, dozens of dot-coms were burning cash faster than they could raise it. Pets. Com spent $300 million on marketing, including a $1.2 million Super Bowl ad. Revenue was $619,000 that quarter. The burn rate was unsustainable. But investment banks kept taking these companies public. Boo! Com, a European fashion retailer, burned through $135 million in 18 months and collapsed in May 2000. Webvan spent $375 million building grocery distribution infrastructure for a market that didn't exist. It filed for bankruptcy in July 2001. The warning signs were everywhere, but the machine kept running because everyone was profiting, except the final buyers. Stage 2, the NASDAQ peak, March 2000. March 10th, 2000. The NASDAQ reaches 5,048.62. Total market cap of all tech stocks, approximately $5 trillion price-to-earnings ratios in the hundreds. Many companies had no earnings at all. 3 days later, the selling began. By April 14th, the NASDAQ had fallen 34%. It would eventually bottom at 114 in October 2002, a 78% decline. $5 trillion in paper wealth vanished, but not evenly. Stage 3, the insider escape. Frank Quattrone and his team had cashed out through bonuses and stock compensation during the boom. Mary Meeker's reputation was damaged, but she remained employed. VCs who got in at early stage valuations had already exited most positions through secondary sales and IPO lockup expirations. The retail investors who bought on analyst recommendations, who believed in the new economy, who invested their 401ks and internet funds, lost everything. Between 2000 and 2002, 50 million Americans saw their retirement savings decline by an average of 50%. Many lost much more. But the real revelation came later when investigations exposed the system. In 2003, 10 major investment banks settled with the SEC and state regulators for $1.4 billion, admitting they had issued misleading research, allocated IPO shares improperly, and allowed conflicts of interest to corrupt their analyst coverage. Frank Quattrone was indicted for obstruction of justice in 2003, convicted in 2004, conviction overturned in 2006. He never went to prison. Henry Blodget was banned from the securities industry for life and paid a $4 million fine. Mary Meeker faced no charges. The network that engineered the bubble faced minimal consequences. Because they hadn't technically broken laws, they had exploited a system designed to allow exactly what they did. The dot-com mirage wasn't an aberration. It was a blueprint. In 2021, 1,035 companies went public through IPOs or SPACs, the highest number since 2000. Many were unprofitable. Many burned cash at rates that echoed the dot-com era, and many collapsed within 18 months. DoorDash went public in December 2020 at $102 per share. It had never made an annual profit. First day close, $189.51. By November 2022, $48. Retail investors who bought at the peak lost 75%. The SPAC boom of 2021 was even more reminiscent. Companies merged with shell entities to go public faster, bypassing IPO scrutiny. Many had no revenue. Some were just PowerPoint presentations. Retail investors, fueled by zero-commission trading apps and stimulus checks, bought in. The insiders, sponsors who got shares at $10, cashed out when retail drove prices to $30, $40, $50. By 2023, the average SPAC was down 70% from its peak. The pattern repeats because the incentives haven't changed. Investment banks profit from deals, not outcomes. VCs profit from exits, not sustainability. Analysts work for banks, not investors. And retail investors remain the final buyers in a system designed to transfer wealth upward. The network still exists. The names have changed. But the machine runs the same way. 3 lessons from the dot-com mirage. First, markets aren't neutral discovery mechanisms. They're networks of aligned interests. When insiders control information, allocation, and analysis, retail investors are at a structural disadvantage. Second, conflicts of interest don't need to be illegal to be destructive. The dot-com system was mostly legal. It was also mostly fraudulent in effect, transferring wealth from uninformed buyers to informed sellers. Third, innovation doesn't require delusion. The internet was transformative, but the companies that survived, Amazon, Google, eBay, were the exceptions, not the rule. Most dot-coms were vehicles for wealth extraction, not creation. The dot-com bubble created and destroyed $5 trillion, but the destruction wasn't random, it was engineered, and the architects walked away wealthy. Because in the timeline of wealth, every rise comes with a hidden cost, and someone always knows who's going to pay it. If you enjoyed uncovering this hidden story, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because history's next secret is already unfolding.